Welcome to Economics Made Easy. In the previous 2 episodes, we discussed that due to scarcity, we must make choices. With choices, there must be criteria for selection, and this inevitably leads to discrimination. Discrimination is unavoidable, so a more meaningful discussion is, who should discriminate? Who bears the consequences of discrimination? Discrimination always comes with a cost. With this foundation, we can use the concept of discrimination to analyze more complex phenomena. Today, we'll talk about 2 issues. 1. Why discrimination is sometimes reasonable. 2. What harmful effects occur if reasonable discrimination is banned by the government. Let's start with a story to illustrate why discrimination is sometimes reasonable. People generally believe that those who discriminate against others are usually in positions of power. But one economist pointed out that this isn't always the case. This economist explained that Chinese people in the U.S. are often considered a minority group, yet in many industries, such as gambling, retail, and finance, Chinese people tend to form tight-knit circles and prefer doing business within their own community. This might appear as discrimination against outsiders. I know a Chinese female economist named Janet Landa. She's an overseas Chinese from Malaysia and grew up there. She once told me that she noticed many anti-Chinese sentiments in her local community. The locals felt that Chinese people tended to exclude outsiders when doing business. She decided to investigate this phenomenon. She visited a small rubber plantation and discovered that the rubber industry in that area was controlled by 5 major families from Shuanzhou and Yongshun in Fujian province. These 5 families, named Chun, Li, Lin, Huang, and Yan, dominated the rubber industry. She found that the emphasis on Confucian principles among the Chinese was a way to assess relationships, essentially a form of credit rating. How do the Southeast Asian Chinese rate people? They divide people into 7 categories. First rank, immediate family members, i.e., close relatives. Second rank, distant relatives within the extended family. Third rank, people of the same clan or surname. Fourth rank, people from the same village. Fifth rank, people who speak the same dialect or other Chinese-speaking people. Sixth rank, Chinese-speaking people who speak different dialects. Seventh rank, non-Chinese people, including Europeans, Indians, and indigenous people in Malaysia. Once people are categorized into these 7 ranks, the terms of business and the interest rates on loans differ according to rank. Why do they do this? Are they being too narrow-minded? We need to understand that narrow-mindedness comes at a cost. If you only do business with other Chinese people, or only with people from your village, your business scope shrinks and you make less money. Through analysis, Landa explains that the discrimination practiced by the Mainan people makes sense. In Malaysia, Chinese people are often isolated. They don't speak the local language, and when problems like loan defaults occur, it's hard for them to take legal action. With no connections, unfamiliar with the local laws, and sometimes living in a jurisdiction with weak legal frameworks, the formal judicial system is often inadequate to protect their interests. So how do they protect themselves? They use this system of distance-based relationship calculations. This method of calculation is a way to protect themselves. It doesn't reduce the profitability of their businesses. Rather, it increases their efficiency. This is what Landa calls the same clan intermediary theory. The significance of this theory is to remind us that we shouldn't view people as isolated individuals without cultural backgrounds. Nor should we simply assume that business environments are either fully protected by law or not. In reality, protection exists on a spectrum. When formal legal systems fail to protect people's business interests, alternative methods like relationship-based constraints can provide that protection. For example, having moral constraints, shared relationships, and reputation within the same village or ethnic group can serve as important tools for safeguarding business credit. This example shows why sometimes discrimination can be highly constructive. Now, let me share another example of what happens when the government bans reasonable discrimination. As we all know, about 10 years ago, the U.S. experienced the subprime mortgage crisis. Between 2000 and 2006, U.S. housing prices soared, but by the fourth quarter of 2006, they began to fall. By 2008, the subprime crisis hit, and the federal government and central banks intervened. People began asking, why did the subprime crisis happen? Why did the housing bubble in the U.S. burst so suddenly? Some said it was due to the greed of capitalists. But capitalists have always been greedy, so greed alone doesn't explain the crisis. Others blamed financial innovation, such as the bundling of various assets and debts, creating long chains that led to information asymmetry between principals and agents, resulting in the financial crisis. But bankers have always been savvy and cautious. Why didn't the merchants in other industries engage in the same practice of bundling and reselling goods at inflated prices? Neither of these explanations fully addresses the issue. The real cause is this. Historically, the U.S. home ownership rate has been low, partly because bankers were very cautious about lending. Most Americans couldn't afford to buy homes. However, starting in 1960, the U.S. embarked on a massive civil rights movement, aiming to correct social injustices by supporting so-called disadvantaged groups and encouraging them to buy homes. In 1991, U.S. commercial banking lending data became public, allowing researchers to study it. They found that, in general, white people had a higher chance of receiving loans compared to minorities and disadvantaged groups, who were much less likely to be approved. This sparked media attention and led to stories about how commercial banks discriminated against minorities. However, commercial banks, under the pressure of competition, would never casually discriminate. If they did, they would lose money. Discrimination always comes with a cost. So if they were discriminating against these groups, there had to be a reason for it, but the public didn't believe that. In 1992, the Federal Reserve's Boston branch published a report claiming that after thorough calculations, it was clear that U.S. commercial banks were indeed discriminating against disadvantaged groups. Despite critiques from experts about the report's poor methodology, the public pushed for more loans to be made to these groups. Commercial banks, being profit-driven, would never relax lending standards without a reason. The government applied both pressure and incentives. The pressure came from the government's threat. If they found discrimination against disadvantaged groups, they would face massive fines and collective lawsuits. The incentives came from government-backed mortgage giants like Fannie Mae and Freddie Mac, which would purchase mortgage contracts from banks, thereby shifting the lending risk to the government. At this point, banks realized they had no risk. No matter how they lent, the government would back them. Since the government was essentially offering a free ride, banks eagerly accepted. They lowered their standards and encouraged people to borrow. Countrywide, for example, had the loosest loan approval standards, and it became the largest lender with the highest borrower satisfaction. Hay stopped vetting applicants' financial status and even hired celebrities to make promotional videos on how to successfully apply for a loan and become homeowners. When all banks adopted these practices, the real estate market boomed. But since everyone was borrowing money they didn't own, the debt was toxic, and the banks, knowing this, traded the bad bets like a game of musical chairs, not knowing who would ultimately be left holding the bad assets. And so the subprime mortgage crisis was born. This story teaches us that when bankers practice reasonable discrimination and the government forces them to change their criteria for lending based on political reasons, it can lead to disastrous consequences. In reality, discrimination often has a reason, especially in highly competitive market economies. Discrimination can often be efficient. If the government pressures commercial banks to change their criteria for discrimination, it can lead to serious consequences. Can you think of an example of discrimination that most people would consider unreasonable, but you think is justified? Feel free to leave me a comment and I'll see you next time. This is Economics Made Easy, where we give you authentic economic thinking